Welcome everyone. Today we're exploring an important business concept. Financial information is a tool, not just a record. Many business owners treat their financial information as something they need for tax filing, bookkeeping, or compliance. But strong businesses use financial information differently. They use it as a decision-making tool. That difference matters. A bank balance may tell you how much cash you have today, but it does not tell you whether you are profitable, whether your pricing is right, whether cash flow is tightening, or whether future tax obligations are being ignored. Businesses that review their numbers regularly are usually better prepared. They can see problems earlier. They can adjust pricing faster. They can plan for taxes more calmly. They can make better decisions about hiring, growth, debt, and investment. The issue is not simply having financial reports. The issue is whether those reports are being used. Example 1. The bank balance trap. A business owner sees $80,000 in the bank and assumes the business is healthy. But $25,000 is owed for sales tax, payroll remittances, supplier invoices, and income tax installments. The bank balance looks strong. The real financial position is much weaker. Business lesson: cash in the bank is not always available cash. Example 2. Revenue without profit. A company increases sales by 30% but does not review margins. Later, the owner discovers the new work was priced too low and required more labor than expected. Revenue increased, profitability declined. Business lesson: growth without financial clarity can create bigger problems. Example 3. Tax planning too late. A corporation has a strong year but does not review income until year end. By the time the tax estimate is prepared, the owner is surprised by the amount owing. Better planning earlier in the year could have allowed for compensation planning, installment planning, or cash flow preparation. Business lesson: tax should be planned, not discovered. Final thoughts. Financial information should not sit unused until tax time. It should help the owner understand what is happening inside the business. The strongest businesses do not simply record numbers. They review them, interpret them, and use them to make better decisions. Financial clarity is not about having more reports. It is about knowing what the numbers mean and what action should come next. Free Small Business Financial Health Scorecard. Are your numbers helping you make better business decisions? Download the Small Business Financial Health Scorecard to identify gaps in cash flow, profitability, tax planning, bookkeeping, and financial visibility. Practical case studies. Practical case study. 1. Too much information, too little clarity. Business situation: a growing wholesale business invested heavily in business intelligence software. Every department produced detailed dashboards covering sales, purchasing, inventory, finance, customer service, and operations. Challenge: leadership received dozens of reports every week, but struggled to identify which issues actually required attention. Meetings became longer, decisions became slower, and important operational problems were often hidden within excessive reporting. Solution: management simplified reporting by identifying the handful of metrics that directly influence profitability, cash flow, customer performance, and operational efficiency. All other reports became supporting information rather than primary management tools. Outcome: leadership meetings became shorter, decision-making improved, accountability increased, and operational focus returned. Key lesson: better reporting is not about producing more information. It is about helping leadership focus on the information that matters most. Practical case study 2. Financial statements became a strategic tool. Business situation: a service business prepared accurate monthly financial statements but reviewed them only for tax compliance. Challenge: although revenue continued to grow, profitability gradually declined because management wasn't using the reports to evaluate pricing, labor efficiency, or customer profitability. Solution: monthly management meetings were introduced using financial statements as decision-making tools rather than compliance documents. Discussions focused on margins, cash flow, pricing, operational efficiency, and future planning. Outcome: the business improved pricing decisions, strengthened cash flow, and identified several unprofitable service lines before they created larger financial problems. Key lesson: financial statements become significantly more valuable when they guide business decisions rather than simply record history. Common mistakes to avoid. 1. believing more reports automatically improve decision-making. Large volumes of information often create confusion instead of clarity. Avoid this by focusing on decision-critical information rather than reporting volume. 2. Managing the business by looking only at the bank balance. Cash available today does not necessarily reflect profitability or future obligations. Avoid this by reviewing financial statements, cash flow forecasts, and key performance indicators regularly. 3. Reviewing financial information only at tax time. Waiting until year-end limits opportunities to improve performance. Avoid this by holding regular monthly financial review meetings. 4. Measuring too many KPIs, tracking everything often means focusing on nothing. Avoid this by identifying the handful of metrics that drive business performance. 5. Producing reports without taking action. Reports have little value if they don't influence decisions. Avoid this by ending every financial review with specific actions, responsibilities, and timelines. Frequently asked questions. 1. How often should financial reports be reviewed? At a minimum, monthly. Growing businesses may benefit from reviewing selected KPIs weekly. 2. Which financial reports matter most? Generally, income statement, balance sheet, cash flow statement, accounts receivable, accounts payable, KPI dashboard. The exact reports depend on the business. 3. Why doesn't a healthy bank balance always mean a healthy business? Because cash may already be committed to taxes, payroll, supplier payments, loan repayments, or future operating expenses. 4. What is financial clarity? Financial clarity means understanding which numbers matter, why they matter, and how they should influence business decisions. 5. Can AI improve financial reporting? Yes. AI can improve efficiency, identify trends, and automate reporting. However, professional judgment remains essential when interpreting the results. 6. What causes poor business decisions? Often it isn't a lack of information. It's having too much information without enough clarity. 7. How many KPIs should management monitor? Focus on the few metrics that directly influence profitability, cash flow, customer performance, and operational efficiency. 8. What's the biggest purpose of financial statements? Not tax compliance. Their greatest value is helping business owners make better decisions. Action plan. Immediate actions. Review your current financial reports and identify which ones actually influence business decisions. Identify 3 KPIs that best measure the health of your business. Schedule a recurring monthly financial review meeting. Next 30 days, build a simple management dashboard focusing on profitability, cash flow, customer performance, and operational efficiency. Remove reports that provide little decision-making value. Introduce cash flow forecasting into your monthly review process. Long-term strategy. Build a financial reporting system that supports strategic decision-making rather than simply compliance. Integrate AI where it improves reporting efficiency while maintaining professional review. Continuously refine reporting to improve clarity as the business grows. Key takeaways. Financial information becomes valuable when it improves decision-making. More reports do not necessarily create greater clarity. Cash flow, profitability, and operational visibility should be reviewed regularly. AI can improve reporting efficiency, but should support, not replace, professional judgment. Strong businesses focus on meaningful financial insights rather than reporting volume. Continue learning if you found this video helpful. Continue exploring these related topics. 1. Why financial statements are management tools, not just compliance documents. Learn how financial reports can improve pricing, profitability, hiring decisions, and long-term planning. 2. Operational visibility, the hidden driver of better business decisions. Discover how stronger reporting systems improve focus, reduce uncertainty, and support sustainable growth. 3. AI and financial reporting, turning information into better decisions. Explore how AI can improve reporting efficiency while professional judgment ensures meaningful business insights.